and the FX market. We're going to have an introduction to the capital market and exchange rates. Then we will move on to talk about the different exchange rate regimes, what have been the ideals and the historical perspective. And then we will close the learning module with a discussion on capital restrictions. So as discussed, within this learning module, we will see how the foreign exchange market is structured, who are the main players, how do they go about conducting their business, most importantly, how are foreign exchange rates quoted and calculated, what are the different exchange rate regimes around the world, how does it impact and affect international trade and capital flows, and finally, what are capital restrictions that governments impose. So, before we jump into the rates and their calculation, I just want to tell you about a little caveat that if you will do forex trading, right? And you must have already seen many advertisements for forex trading. And let's say we're talking about Euro USD. So in forex trading, when you see Euro USD, it's going to be written like this, or it's going to be written like this, or it's going to be written like this. Now, this is different than what you will be seeing in the CFA curriculum. In the CFA curriculum, what we will see is if you see Euro USD, if we're talking about Euro USD, it's going to be written as USD Euro. So clearly, you can tell the difference between these two. Now, technically, which is the correct one? It's the one that we're discussing in the CFA curriculum. This is technically the correct one. But in the market, the market practice is to write it the way I have shown you over here. Now, why is this CFA curriculum one technically the correct one? Because let's say the rate for Euro USD is 1.4. Now, what that 1.4 means that for each 1 euro, you can get 1.4 US dollars, right? Or if you want to buy 1 euro, you have to pay 1.4 US dollars. So that is why this is technically correct, because USD/euro indicates that you're saying that euro is in the denominator, right? It is in the denominator, and that is the technically correct situation. Here, you're writing it like this, where you're writing euro first and you're writing USD second, but it is not USD that is in the denominator. It is still euro that is in the denominator. It's just written, euro is written first and USD is written second. So please don't get confused with the market practice way of writing things. We are studying for the CFA Institute and the CFA program exams. So we are going to be focusing on this version over here, where the second part that you see is the denominator, and that is the one which we will be referring to as the base currency in a quote. And the one that is in the numerator, this is referred to as the price currency. Anyways, this will become more clear to you as we go through the learning module. So what is so special about the foreign exchange market? Well, one of the things which is very special about it is that it is huge, massive, much bigger than your equities. So how much bigger? 50 times larger than your global equities, and 10 to 15 times larger than your fixed income market. So it is huge. Now coming to the exchange rate, it is the price of one currency expressed in terms of another currency. So 1 euro is priced in 1.5 US dollars. So if you see a quote that they are willing to buy or sell euros at 1.5 US dollar. That means it is priced in US dollar. So that is the price currency, the dollar. And what are we buying or selling? The base currency, which is euro. Stated otherwise, in the number of units, the price currency needed to buy or sell 1 unit of the base currency. So we're basically talking about euro, which is the base currency, and we are giving the price in dollars. And that is what you see over here, right? Consider an exchange rate quote of 1.45 USD per euro. So here USD is the price currency and the euro, which is the denominator, is the base currency. If you want to buy 1 euro, you can buy it for 1.45 US dollars. So if 1.45 US dollar per euro is interpreted at, so it is interpreted as 1.45 dollars per euro. You're using dollars to express the price per unit of euro. Hence, dollars is the price currency here. Now, what could get confusing, and it does, that let's say this 1.45 goes to 1.5. So 1.45 dollar per euro becomes 1.5 dollar per euro. Now, is the dollar going up? Is the dollar becoming strong, or is the euro becoming strong? And you know, the sort of knee-jerk reaction here, or the immediate sort of human reaction here is that, oh, the dollar is becoming strong because the number of the dollar is going up. But that is wrong. And now think about it logically, that before you needed to pay $1.45 to buy a euro. Now you need to pay $1.5 to buy a euro. You need to pay more dollars to buy a euro, which means that it's the euro that has gotten strong, right? If it was the other way around, let's say it went to $1.4 per euro. So before you needed to pay $1.45 to buy a euro. Now you only need to pay $1.4 to buy a euro. So that means the dollar has gotten strong. Easy way to remember this is whichever is in the base currency, that is the currency that we are talking about. So the price currency could be anything. But if this quote is going up overall, number wise, then it is the base currency which is getting strong. And if this quote is coming down, then it is the base currency which is getting weak. And that is what is written here. If the quote rate increases, base currency has appreciated. All right. So what I want you to do is pause the video and tell me, or rather tell yourself, that which currency has appreciated. The rate has gone from 1.416 to 1.405. Pause the video and write down, or just tell yourself which currency has appreciated. So 1.416 is obviously greater than 1.4051, which means the quote has gone down, which means the base currency, which is euro over here, has depreciated and the dollar has appreciated. So euro has depreciated and US dollar has appreciated. Second one, this is going up or going down? It is going up, which means the base currency is becoming strong, and that is the US dollar. US dollar has appreciated, Indian rupee has depreciated. And for the last one, it is going down, so base currency is going down and price currency is going up. The Swiss franc is appreciating. Now this part of this learning module is deep, and I'm not going to go that deep. I'm just going to explain it at a higher level so that you don't get confused. And we try to keep an exam focus so that we only understand things ideally at a level where it is going to be tested. So what happens is, let's say the change in currency, euro is going from 1.4 to, let's say, 1.45. So there is a certain change, right? But at the same time, the inflation in Eurozone is also changing, and the inflation in the USA is also changing. So if we want to know what is the impact on the real exchange rate. Now, what is the real exchange rate? The real exchange rate is after adjusting for inflation. So what we do is we don't really take it in terms of numbers. We take the change in the nominal exchange rate. So if it's going from 1.4 to 1.45, so that is basically a change of, so let me calculate that for you. 1.45 minus 1.4 divided by 1.4 multiplied by 100. So that is a change of 3.57%. So the change over here is, let's say, 3.57%. And the euro has strengthened. Why? Because the quote has gone up. So the euro has strengthened how much? 3.57%. But then before I can tell you what will be the impact on the real exchange rate, if there is a business house which is interested in knowing what is the real exchange rate impact between the US and euro, then they will be doing this type of calculation. And for that, they need to know what is the change in the inflation in Europe, right? And what is the change in the inflation? The consumer price index is what tells you the inflation in the USA, right? And then we will be able to find out what is the real exchange rate. So that this is the high level understanding that you need to have. Don't worry about it too much. What you need to pick up over here is that the real exchange rate is related directly to the change in nominal exchange rate. So if nominal exchange rate is going up, let's say 3.5%, it is becoming stronger, then your real exchange rate will be obviously becoming stronger as well, close to the change in nominal. But we do need to make an adjustment. If the base currency inflation is going up, so then that will definitely directly impact positively, because this is in the numerator. And if the price currency inflation is going up, then this is naturally going to reflect it negatively. Now, why is that? Is because the price currency inflation is not going to be good for the price currency, because it is going to get weak. The higher the inflation, naturally, the more weaker that currency is going to get. But again, I don't think you should worry too much about this material over here. What you should just remember is that we are having price in the numerator, base in the denominator, price in the numerator, base in the denominator. But for this last part, it is upside down. The CPI is having the base in the numerator and the price in the denominator. And just remember that the change in the nominal one multiplied by the change in the base CPI divided by the change in the price CPI is going to give you the change in real exchange rate. And therefore, the real exchange rate change is directly related to the nominal exchange rate, directly related to the base currency, and indirectly or inversely related to the price level in the price currency. Okay, let's now move on and talk about who are the participants in this massive foreign exchange market of approximately $6 to $7 trillion per day, right? It's huge. So who are these people, and how can we segregate them in terms of buy side and sell side? Now, sell side are people who offer, right, exchange services. So they're selling the service basically. And the buy side is people who are buying the service, like high net worth individuals and funds that need to invest and change currency, or companies which are doing import and export, right? And now we have a list coming up. So let's focus on the sell side first. Who are these exchanges? The big banks, Deutsche Bank, Citigroup, UBS, HSBC. They provide you foreign exchange services. And you might be thinking, but in my local society, it is that shop that is an exchange house. Well, yes, but behind those shops and behind all the foreign exchange retail outlets that you see, it is the big banks that do these major transactions. And then, of course, there are second and third tier banks as well that are doing it. But the large ones are in front of you over here: Deutsche, Citi, UBS, and HSBC. Now, buy side is long. This is just one slide. There's another slide coming up after this. So starting off with retail accounts, individuals, tourists, exchanging currency, going for international travel. So let's say you're American, you're going to Europe, you're going to sell your dollars, buy some euros, and enjoy that vacation in France, right? Or maybe you are a business doing import export. You're importing some Louis Vuitton bags from France, or maybe some chocolate from Belgium. So you need euros for that. So corporations using foreign exchange transactions for cross-border trades of goods and services. They could be high net worth clients. Maybe you're looking to invest in the German DAX index or the British FTSE. So you'll need pounds for that. So you have to convert your dollars into pounds to invest in the FTSE index in the London Stock Exchange. Right? There could be other institutional investors, mutual funds, exchange traded funds, pension funds, endowments, etc., such as the Harvard University Endowment Fund or the Cornell University Endowment Fund. So these are institutional investors. You have other type of institutional investors which use leverage, such as hedge funds and high frequency algorithmic trading, or even governments that need to buy and sell foreign currency. Which brings me to central banks. And sometimes central banks really need to participate in the foreign exchange market in a big way. The example here is regarding India, but I would like to remind you of the example of the Bank of England, where they tried to arrest the crash of the pound by selling the dollars and Deutschmark in their reserve and trying to buy the pound, but they were unable to do it. And one person who made a huge profit on that is George Soros. Right? He shorted the pound and made $1 billion approximately in one day. Same situation was there with India 2012 to 2013, where they were facing a depreciating Indian rupee and they had to sell dollars from their reserves and buy Indian rupee to support the Indian rupee. So sometimes central banks really participate in a big way to manage their domestic exchange rate against the dollar and against other major currencies. Then you have your sovereign wealth funds. So countries like Norway, UAE, and Saudi, of course, Kuwait, China, they have a lot of money as a country. So they have these wealthy sovereign wealth funds. And these sovereign wealth funds, of course, have to invest across the world in different types of investments, infrastructure projects, real estate, to earn returns and, of course, expand their influence. And naturally, they need currencies of all those countries in which they are going to invest in. Right. Now, the next 3 slides are going to be showing you some data from the curriculum, but you're not required to remember this data by heart. You don't need to memorize this data. Just try and get an understanding that what is trying to be communicated over here. Now, this first one is trying to tell you that majority of the transactions that happen in the foreign exchange markets, the biggest ones are swaps, where let's say you are an American company. And of course, you will learn a lot more about swaps when we get to derivatives, because that is where it is covered in detail. But I'll just give you a high-level introduction over here. Let's say you're an American company, you want to start up business in France, and there's a French company that wants to start a business in the US. Now, you can borrow in US at a low cost. The French company can borrow in France at a low cost. So what they can do is they can borrow for you in France and give you that loan in France for your business in Paris, and you can borrow in, let's say, dollars in New York and give that company a loan in dollars, right? So you guys can have a swap. So this is, of course, a huge area in FX, cross currency swaps, which you will learn about in detail later in derivatives. The second biggest is your actual genuine spot currency market, where you're having people giving one currency and taking the other, and then the rest outright forwards. This again you will learn about in derivatives more, that it's like the spot market, that you're giving one currency and taking the other, but at a future date. So the only difference over here is that it is not done on the spot. The transaction is done at a future date. Here, of course, the transaction is on the spot, and that doesn't mean that it's immediate. Usually there is a 2 to 3 day settlement period, but 2 to 3 day settlement period is considered on the spot. And then of course FX options, where you have a right to convert if you want, or but nobody can force you. So you kind of get like a option to convert at 1.4, let's say, euro or dollar per euro. But if you want to do it, you can do it. If you don't want to do it, nobody can force you. So that's why it is called an option, because you have the option. Anyways, more about that in derivatives. Second data shared over here is that the biggest people who are doing these transactions are either financial clients. Think of companies, think of high net worth individuals, think of sovereign wealth funds, think of just financial other funds, mutual funds, hedge funds, so financial clients. And then of course you have your interbank, so banks doing it among themselves. And that also happens because sometimes, let's say we have HSBC and we have Citibank or Citigroup, and Citi might have too much of an exposure to pound, which then it can cancel with HSBC, and HSBC could give them some dollars, and they could just have a interbank settlement among themselves to bring their respective exposures to a level where it's okay for them. So a lot of interbank transactions going on, and of course you have your retail and other types of non-financial clients. Again, you don't need to memorize this, just have a idea that retail is small and interbank and financial are the main biggest ones. Then you've got your pairs data. So the biggest one is of course euro and USD. Naturally, since America is the biggest economy, and the European Union, or rather the biggest, some of these huge economies that we have, such as Germany and France and the other big ones, Italy, right? If you combine them, so that's pretty big too. So of course, since America and these countries are such huge economies, naturally, it is only natural that the volume of their pair, their currency pair, is going to be the largest. Japan is, of course, also a massive economy. Then on its heels, or much further back, actually, you have the British pound, and then much further behind that is the Australian dollar, and then close on its heels is the Canadian dollar, US dollar volume. Right. So the exchange rate is the price of one currency relative to the other, typically quoted at 4 decimal places. Again, in the forex market these days, when you will go and see quotes, you will see that they are now done at 5 decimal places. A lot of brokers, forex brokers, are now doing 5 decimal places, but original is 4. So for example, euro USD, first of all, they will write it like this, where actually the technically correct way is to write it like this, even though the base currency is euro, but they're still writing it first. And let's say 4 decimal places means something like this, that here you have 4 decimal places, right? 4013. But in the market you will see some things like 4013, and then there'll be like a small number written at the end, which is basically the 5th decimal space, but they're just writing it in a weird way. Also, something you're not required to know, but I will tell you for your understanding, general understanding, that there are quotes like, so this previous one, let me just go back, JPY USD. JPY USD is, first of all, it's having USD in the base, but in the market you will see that it's written like USD JPY, even though USD is the base, but it is written first. And it is going to be like something 100.23, right? Because it's like approximately $1 is approximately 100 Japanese yen. So that's why instead of 1, you have 100. And therefore in the decimal, you don't have 4 decimal places, you just have 2. Whereas in your forex market, you will have maybe the 3rd decimal also as well. So like they're giving an extra one for this, they're giving an extra one for this. And therefore, if you have 4 decimal places in your quotes like Euro USD, then you will have 2 decimal places for quotes like JPY USD. And then in some of the brokers, instead of a 4-2, they have like a 5-3. That for quotes like Euro USD, they're doing 5 decimal places, and for quotes like Japanese yen USD, they are doing 3 decimal places. So 5-3 and 4-2 brokers. But what you need to focus on obviously is the 4-2 brokers, and even within that you need to focus on the 4 decimal place quotes, which is your Euro USD. And let's take an example. So let's say you have this quote 1.4000. So they are giving you 4 decimal places, 1, 2, 3 and 4, right? So this means you can buy or sell 1 euro for 1.4 US dollars. If you want to know what is the price of a US dollar in euro, so if you want to make euro the price currency and US dollar the base currency, well, you have to just turn that quote on its head, right? You have to turn it upside down, which means also taking the reciprocal. So that is just 1 divided by 1.4, which is 0.7142. So you could take the reciprocal and you will get the quote with euro in the price and dollar in the base. So what is a direct quote? What is an indirect quote? And tell me one thing. Let's say you are going to the local supermarket, and let's say you live in the US. So everything in the supermarket obviously will be having prices in dollars, right? If let's say you live in London, so when you go to the supermarket, everything will be in pounds. If you go to the supermarket in Germany, everything will be in euros, correct? So just like that, if you want a direct quote of a foreign currency, the price currency has to be your local currency. So from an American perspective, the price currency should be the American currency, and that is a direct quote for the people in the US, because the price should be in their currency. Just like you go into a supermarket, the prices are in your local currency. If, for example, the base currency is the price currency, right, and the foreign currency, or so your domestic currency is the base and the foreign currency becomes the price currency. So here, let's say if you are American, your domestic currency is US dollar, and if that becomes the base, right, and the foreign currency, which is euro, becomes the price, then it becomes an indirect quote. So just to make sure that you've understood this properly, can you tell me that from a German investor's perspective, is this a direct quote? So is the euro in the price currency? No, the euro is in the base currency. Then for a German investor, this is going to be an indirect quote. If the German investor wants a quote, they will want euro to be in the price and dollar to be in the base, or whatever currency is in the base, the price should be their currency. Only then it will be a direct quote. Okay, now moving on to bid-ask spreads. Now you might be thinking, how do these dealers of foreign currency make money? I mean, if they're going to buy at 1.45 euro, or let's say dollar per euro, and they're going to sell at 1.45 dollar per euro, then how do they make money? Well, they're not that silly. They don't buy and sell at the same price, and whatever rate they are willing to buy at is going to be what they are bidding at, right? So if you buy something, or if you're willing to buy something, what you do is you bid for it, right? So the rate at which they are willing to buy, and of course we're talking about buying or selling the base currency, and the price is obviously quoted in the price currency, but whatever rate they are willing to buy at is the bid rate, and whatever the rate at which they are willing to sell will be the ask rate. So for euro, it will be something like 1.44 will be the bid, and 1.46 will be the ask, which means they will buy from you each euro for $1.44, and they will sell to you each euro at $1.46. Bid will of course always be less than the ask. Nobody wants to buy high and sell low. So another example here with euro in the base and USD in the price, and clearly they are having a decent spread over here. 1.3990 for buying and 1.4010 for selling. That means the dealer is willing to buy each euro for $1.399 and willing to sell for $1.401. So that is the ask, and this is the bid. Okay, another interesting example. Appreciation of one currency is the depreciation of the other. So say the USD euro rate is going from 1.4 to 1.5. Euro in the denominator, USD in the numerator, rate going up. Clearly, euro is getting stronger because we know that is the base currency, which either is becoming stronger if it's going up, if the quote is going up, or weaker if the quote is coming down. That is easy for you to do. That USD is becoming weaker or depreciating, and euro is becoming stronger or appreciation. But what I want to emphasize on is the percentage of appreciation of euro versus the percentage of depreciation of the US. And how did I calculate this? So first of all, we put euro in the base and dollar in the price, and we see, okay, it has gone from 1.4 to 1.5. So the difference is 1.5 minus 1.4 divided by 1.4 multiplied by 100, and we find out that 7.142% the euro has become stronger. But then if we take the reciprocal of this 1.4, which is 1 divided by 1.4, and the reciprocal of the 1.5, which is 1 over 1.5, we find out that the pair with dollar in the denominator or the base and euro in the price has gone from 0.7143 to 0.6667. And that, when you calculate the change, which is ending minus beginning divided by beginning. So ending value minus beginning value divided by beginning value multiplied by 100, you find out that the change is not the same, right? Because the base is different in the two situations. And this is something you have to keep in mind, that even though one is appreciating and the other is depreciating, that does not mean that the percentage of appreciation and depreciation is the same. So we're going to stop this video here, and in the next one, we'll pick up with the different exchange rate regimes.